Hello, everyone, and welcome to the Buck Stops Here. I am Catherine Murray. Well, it is interesting to see these markets continue to move higher, despite the fact that we have a number of headwinds or potential headwinds. To discuss all of this is Bipan Rai. He's managing director and head of ETF and alternative strategies over at BMO. Bipan, great to be able to talk to you again and get your perspective and share your thoughts on the macro picture here. Let's start with the macro because we do have some headwinds, geopolitical tensions, trade and tariff concerns, just to name a few. Where do you stand right now?
Certainly. I mean, from a top-down macro perspective, it still feels like there's a lot of things going in the right direction, despite the risks that you mentioned, Catherine. Right? I mean, if we look at just sort of the economic backdrop of both the United States and Canada, I mean, private sector demand remains relatively strong in both countries, particularly so in the United States. But Q2 in Canada has also been very, very strong, right? So you take that into consideration with the way that the markets have been evolving, especially the equity markets in both countries. I mean, earnings growth has been incredibly strong over the past year, and markets are discounting even stronger earnings on a go forward basis. So I would still say that this is a regime that's characterized by strong growth and maybe a little bit higher than usual inflationary pressures. But again, over the coming quarters, I mean, the risks are shifting potentially towards lower than expected inflation relative to where we've been over the past couple of months. So this is still a fairly healthy backdrop when it comes to the broad macro. And again, that could favor some degree of pro risk behavior or pro cyclical behavior, I should say.
And so let's talk a little bit about that in the sense that why are we seeing such strong earnings growth?
Right. It's a great question to ask. And again, I mean, the easy answer here is that we're going through an incredible productivity boom, and that productivity boom is being engendered by AI. And of course, the demand for AI remains relatively strong. When we're talking about the different layers that apply to the AI value chain. And so far over the past couple of years, I mean, most of it has been concentrated in a few sectors, but more and more what we're seeing is this broadening out theme, not just in terms of sectors within the U.S. and within Canada, but also regionally as well. So we're seeing a greater degree of participation in the AI theme. And you take that out of the market and speak to the words of broad economy in general. We're seeing the ripple effects there too, right? And that, of course, is engendering stronger demand from the private sector. It's not leading to the mass wave of layoffs that was part of the initial concerns with respect to AI. And all that, taken together to me suggests that this is still a fairly robust backdrop for broad risk, and of course, that's been reflected in the increased expectations for earnings as well.
Yeah, it's been quite incredible. And just going back to your comment on inflation, there has been concern that it's higher and perhaps higher for longer. Do you believe that we'll see that? And my question is, are we really even reflecting what's been going on in the Iran Mideast tensions as it relates to energy, the higher cost of energy flowing through to all the supply chains? It's surprising that we haven't seen that.
Yeah, it's a good question. And, if you'd asked me this question in March, I mean, my answer would have been totally different. I would have expected inflation to become more and more entrenched, potentially looking at the 4% handle in the United States. And whereas in Canada, we probably would have remained embedded in the 3% plus range in Canada. But that hasn't played out. And again, a lot of that could be related to headline whiplash with respect to US policy in the Middle East. But some of it also could tie to other factors as well. The fact that we are seeing some rerouting of shipments away from the Strait of Hormuz. The fact that we haven't seen increased Chinese demand, uh, really with respect to energy imports. I mean, all of that has kept more or less a lid on oil price volatility relative to what we saw in March, and that's helped at the margin. Now, can inflation continue? I mean, are there tailwinds for inflationary pressures moving higher beyond energy? I would suspect that there are, and a lot of those in the near term are related to demand in the AI space, right? With respect to building out data centers and the like. I mean, that requires labor, that requires materials. And again, in an environment where the trade backdrop is fracturing, I mean, that leads to upside pressures on prices.
Yeah, I mean, it's quite incredible to not perhaps have more of a concern in various sectors when we do know that this AI data spend is climbing. And it's interesting, even just to see the amount of bonds that we are expecting to be issued over the next year to support that AI spend and all the energy and infrastructure it's going to take to implement. I'm surprised we're not seeing. Look. I'm a big believer in the equity markets, and I'm thrilled to see them move higher. But it's interesting that it seems to be ignoring it a bit.
Yeah, you could make the case that, with the sheer volume of bond issuance that we're seeing, not just in the corporate space, tied, of course, to the AI build out, but also, if we're talking about the sovereign space, I mean, the US Treasury has been issuing a lot of treasuries over the last several years. And of course, the deficit remains incredibly elevated. But that's not just a US centric story. We're also seeing that in Canada, seeing that across the Eurozone as well. And that, of course, is tied to the fact that the trade backdrop is fracturing and a lot of countries are spending more domestically. Now, if you ask me why we haven't seen this reflected in the equity market, again, it ties in my mind, to the expectations of a productivity boom led by AI. And to me, that tells me that interest rates simply aren't high enough to trip equities at this point.
Okay, we'll take a quick break. We'll be right back. Bipan, it's interesting, when we talk about a lot of countries looking inward, trying to manufacture a little bit more inward spending, you're seeing increasing deficits and debts. One area, of course, that we as Canadians sitting in Canada have to consider, and I don't know that it's getting a lot of airtime, is USMCA or CUSMA and what's going on with U.S. trade relations. How should we be thinking about that and incorporating that into our investing?
Yeah, it's a very important question. I mean, given the fact that Canada is a trade dependent country and our largest customer is south of the border, and of course one that our economy is heavily integrated to deal with on a go forward basis. I mean, we're in quite uncharted waters when it comes to tensions with the United States over trade, or at least we haven't seen this degree of tension in quite some time. If you're asking what the base case scenario for the USMCA is, at this point, I mean, to me, it still feels like there'll be some sort of agreement, maybe stricter terms of when it comes to rules of origin, how Canada deals with or trades with China, maybe some sort of Fortress North America like block. But again, this is all stuff that's speculative, at least at this point. And if nothing happens, if we do see the 50% Section 338 tariffs go into effect on August 19th, I mean, then we could be staring down the barrel of, say, annual reviews with respect to the USMCA up until the agreement lapses in 2036. And of course, that wouldn't be very constructive for the domestic business investment backdrop. And of course, that could increase some degree of uncertainty when it comes to households as well, given the fact that a large percentage of employment in Canada does depend on trade with the United States.
And I wonder, though, if it isn't already having an effect. Technically, Canada is in a recession, the only of the G7 countries to be in a recession. Whether this is forward looking in terms of the lack of domestic production, or is it real? Are we actually already seeing business sentiment drop off to the point where we're having less growth?
Right. So, I mean, I would kind of push back on the characterization of this being a recession. I understand technically that view is correct. I mean, we did see 2 quarters of negative growth, but if we look at the Q2 data so far, I mean, it's been incredibly strong. In fact, we're tracking growth of just above 2.5%, and I think part of that does reflect the fact that given the fact that we are dealing with an uncertain backdrop with the United States, at the same time, business sentiment seems to be discounting that more and more, or at least that's been reflected in the data more and more. And we are starting to see some degree of benefits when it comes to how heavily we're invested in the commodity space. And of course, that's also been helping our trade situation as well. To me, I would sort of say that businesses have become better at discounting it. Sure, there's a fair bit of uncertainty on a go forward basis, but it does feel like we should settle into a new equilibrium, provided something new and nefarious doesn't happen at this point.
When you look at the US, though, the household income there seems to be a little bit more steady and growing.
Yep.
So does that, from a relative perspective, make us more interested in owning US equities as an example, or buying into the US trade?
I mean, it's a very good question. If we're talking about the U.S. market versus Canada, I mean, certainly then we have to entertain the idea that this is a theme that's been going on for some time. And how's the U.S. value? how's the U.S. market valued relative to the Canadian market. And I would say that you could probably get better value in the Canadian market at this point, and there's a lot of really good stories in the domestic market that could continue to play out and benefit not just the economy but the domestic market. But if you're talking about the U.S. market, I mean, earnings growth over the next 12 months is expected to be close to 30%. I mean, that's a lot of good news baked into the price already. Right now, if we do reach those expectations or even exceed them, I mean, great. I mean, that's good news for the U.S. equity market. But failing that, I mean, we're really just looking at potentially narratives to drive the U.S. market higher via multiples expansion. I just don't think that story is going to be, as firm or as reliable as it has been in the past. Whereas the Canadian market, I mean, we're pricing in close to 20% earnings on a year-over-year basis. I mean, given what we've seen in terms of the material sector and of course the strength in a few metals, also energy prices have remained relatively elevated, and I expect them to remain elevated on a go-forward basis. Those are two very constructive themes that could potentially benefit Canada. Now, of course,
Right.
banks are going to be an important part of that as well, but again, to me, I'm still constructive on banks despite the valuations.
All right, we'll take a quick break. We'll be right back. Bipan, I'm excited and curious about your thoughts on the Canadian market. I, quite frankly, have been struggling as to where I would want to put money to work. So let's break this down a little bit. And why don't we start with the Canadian banks? I think there's a lot of people who are saying they've had such a great run. Is it too good to be true? And I know you have an ETF that writes covered calls on the Canadian banks, which I think is probably a really smart strategy here. But let's look at the Canadian financials to start.
Yeah, I mean, we've been constructive on Canadian banks for the better part of the last couple of years, and there's good reason for that. I mean, Canadian banks, if you look at them, they're very good at diversifying the revenue streams, right? And that's something that I think is underappreciated in the market, and something that's very different than what we've seen over the past couple of decades, right? So, I mean, if we're talking about expanding the footprint in the United States, I mean, that's been a great driver of revenues for Canadian banks over the past year. Also, I mean, if we're talking about increased chop in the market, increased volatility, I mean, capital markets divisions of Canadian banks can do reasonably well in that environment. And of course, expanding the footprint in other spaces, including wealth management, has also helped Canadian banks insofar as, when markets rise, obviously there's a lot more revenue that can be generated from wealth management divisions. So, I mean, the aspect of diversification of revenue streams has helped Canadian banks, especially in backdrops where loan growth has been slow, including 2025. Right.
Right.
So, I mean, if we're moving forward into an environment where the Canadian economy is recovering and we expect to see loan growth improve, I mean, that puts Canadian banks still in a fairly favorable position. And also, the one thing that we shouldn't look past is that Canadian banks are incredibly well capitalized right now, right? They hold capital well above regulatory minimums. I mean, that there's good potential there where we could see an increase in dividend in some cases where loan growth isn't there, and also potentially share buybacks as well. We've seen Canadian banks move in that direction. So, you could argue Canadian banks are overvalued right now, and I'm not going to mount a counter argument to that. But to your point, Catherine, I mean, this is an environment where something like a covered call strategy could work fairly effectively. And again, we do have a fairly successful covered call ETF that tracks Canadian banks in the form of ZWB, the BMO Covered Call Canadian Banks ETF. That's done incredibly well so far this year. And we think that these sorts of instances where valuations are elevated, that's the strategy to pursue.
And I think we should just describe what a covered call is.
Right. Right, of course. I mean, it's a covered call is a strategy where basically the portfolio manager will write out of the money calls on the underlying holdings, right? So what that does help is that it does allow the holder of the ETF, the covered call ETF, to harvest an income at the same time that they're holding the underlying. Now, the downside to that is that your upside is capped, right? So, but yeah, at the same time, though, I mean, if we're moving in an environment where, say, share prices of the underlying are consolidating, then you still get that added kicker of having that income on top of it, which can be very beneficial.
Great. I do think it's a nice way to add some income to one's portfolio. Broadening it out and taking a look at the Canadian economy, materials. Where do you stand on materials now? And what's an interesting ETF that supports that thought?
Yeah, it's a great question. I mean, if we're talking about materials, not just in Canada, but mostly globally, I mean, we're talking about primarily firms, especially if we're talking about miners in the gold space, with fixed costs that they're already in, and with operating margins that are already quite positive. Now, on top of that, I'm fairly constructive when it comes to metals writ large. In fact, commodities to me is potentially going to be an asset class that outperforms in this regime that we're in. And if that's the case, then I mean, to me, it suggests that there's probably more upward pressure potentially on margins when it comes to upward operating margins, I should say, that could continue to benefit the materials sector. So again, that's a sector that we continue to look favorably upon. And one of the ETFs that has done really well for us this year has been the BMO Equal Weight Global Metals ETF, the ZMT. That's another ETF that I would point to and say that that should be in the right position to take advantage of this theme. Additionally, I mean, if you just want to have participation in the materials sector in Canada, but also have a bit more diversification there, there's nothing wrong with just going along an ETF that tracks the TSX, including the ZCN that we offer here at BMO Global Asset Management. And if you want to broaden it out towards commodities, because again, in this backdrop where inflation is a little bit higher for longer, the commodities should be an asset class that tends to perform. We just launched our ZCOM ETF, which tracks the Bloomberg commodity index. That has been running for us over the past several quarters and has done fairly well so far this year as well.
Okay, great. We'll take a quick break. We'll be right back. Bipan, it's interesting when we take a look at the metals sector, and I'm assuming that's a bit of a play not only on inflation but also potentially this AI build out. Um, and it is global. You've pointed out that it is a global theme for sure. I'm wondering from a global perspective as well, what else is interesting? I'm curious about your thoughts on emerging markets.
Yeah, emerging markets is interesting. And traditionally, if we were talking about emerging markets, inevitably we would talk about the miners, especially consider the exposure to Latin America. And of course, there's a lot of copper that's produced in countries like Chile and Peru. But more and more, especially in 2026, believe it or not, emerging markets has become the AI trade. 50% of the MSCI emerging markets index basket is comprised of two countries, Taiwan and South Korea. 30% of the basket is comprised of three companies, I should say. So SK Hynix, Samsung, and TSMC, right? So these are all
Right.
upstream AI plays, believe it or not, that have made effectively the emerging market basket become more and more concentrated, and really just a bet on further demand for AI outside of the United States. So it's tricky. I mean, if we're talking about the view on emerging markets, it feels more and more that we're talking about still upstream demand for AI. If we're talking about high bandwidth memory manufacturers or just semiconductor chip manufacturers as
Mm.
well. So it's a bit of a tricky sort of
Yeah.
circumstance to navigate, Catherine, when it comes to EM.
It almost seems as though I may have missed that trade. I'll just stick with my other AI trades,
A
but
lot of people did, yeah.
yeah, unexpected. Real quick here as well. There's always interesting reports about if you just put, $1,000, $100, whatever it is, into the S&P 500 and you never sell and you hold it for 20 years, you will have done very, very well. So let's talk about getting exposure, very basic exposure to the US markets, S&P 500. What ETFs do you have? And the big question I always get from people is do I do a hedged ETF or
Right.
unhedged?
Right. Well, if you want just broad exposure to the S&P 500, I mean, our ZSP is a fantastic ETF that allows you to do that. It's one of the largest equity ETFs in Canada, so there's a fair amount of liquidity there. And again, it allows investors that just want generic exposure to a market cap weighted index. It provides that exposure. It's been one of our more successful ETFs so far this year. And certainly, we do offer it, as you allude to, Catherine, on a hedged and unhedged basis. So, what that means effectively is because the underlying is a US asset, so it's a basket comprised of the top 500 largest US companies, then there's the underlying exposure there is in US dollars. And of course, anytime you invest outside of the country, unfortunately, foreign exchange risk is an inevitable part of that reality. So, having the unhedged exposure means that you're also participating whenever the US dollar appreciates relative to the Canadian dollar. Now, the downside to that is if you're unhedged and the Canadian dollar appreciates, that can work against you in the return that you're earning off of the underlying movement. Now, the hedged version of that basically obviates the FX risk, right? So, the fact that it's unhedged versus hedged is an important conversation, an important point of consideration whenever you're looking outside of Canada to invest. So, with respect to the S&P 500, my answer usually is the same. I mean, over the medium to long term, because the US dollar has appreciated against the Canadian dollar, I would say that if you're a long-term investor, think about unhedged over the hedged option with respect to the S&P 500. And the reason why I say that is not just because the US dollar has appreciated against the Canadian dollar over the medium to long term, but the US dollar traditionally has an inverse relationship with the S&P 500. And what that means is that overall that dampens the underlying volatility relative to a hedged position in the S&P 500. Of course, we're talking about returns, but we'll also need to consider the volatility as well. So if we're talking about a damper volatility profile relative to return, your Sharpe ratio is just a little bit better with an unhedged exposure to the S&P 500. Now, the answer would be different if we're talking about U.S. Treasuries, because the U.S. dollar does tend to be positively correlated to U.S. Treasuries, so it doesn't actually dampen the volatility as much.
Hmm. It's a lot to consider when it comes to hedged and unhedged. Hedged, if you think about hedged, it means you're just going to get the return of the S&P 500.
Correct. So it does actually obviate any sort of FX risk that you would potentially be exposed to. What that also does mean, though, is that the U.S. dollar does appreciate relative to the Canadian dollar. The hedge position wouldn't capture that either.
That's right. Okay, Bipan, great to be able to speak with you today and get your insights and views. Really appreciate it.
Thank you for having me, Catherine.
Thank you. Thanks for watching. Join us next time on The Buck Stops Here. I'm Catherine Murray.